Hello, Doc C here. It is let's see, June 18th. It's been a while since we've been on here working with small business owners, of course, our passion, and we've been doing it for 30 plus years. Again, my name's Doc C. Today we're going to be talking about ratios. I kind of talk about this a lot. Especially when we work with business owners looking at their P&Ls, tax returns. And a lot of times, if you, as a business owner, can look at your own P&Ls and tax returns and so forth, you can actually see your margins and see them come alive, actually, and help you with that. As you know, what we do is we specialize in our E4 system. Let me go ahead and show you my screen here. There we go. And let me show you. All right, if you can see that, we did a seminar, accounting show back in last fall, and we did a little seminar on how to run your business or professional practice more profitable, enjoyable, and eventually sellable. And this is the system that we actually use. We call it the E4 math philosophy system. And if you look at the top right-hand corner, entering, it says your company's Z-score. So really kind of what that means is that if you are entering a business for the first time, there are two things really. Well, there's more than just two options, but the first option is that you start your business from scratch. You start it from your garage, your bedroom, office, or whatever it is, and you start it from scratch. That's one. Number two, you acquire a business, and when you acquire a business, you really want to start off by understanding the business, that you're going to acquire, and their Z-score. The Z-score has been around for a long time. A lot of people banks used to use it a lot. I don't see them using it as much, but it is an excellent indicator of whether or not this business that you're going to acquire is going to be there for you for the next 3 to 5 years. I know things change. We have variables we look at and so forth, but that's the idea. The second thing right over here, evaluation to boost your cash flow. That's what, of course, we do as well. And we evaluate, we come in and we're kind of like the business doctor. That's why we call ourselves primary business consultants. It's because we're going to come in there and look door to door, front door to back door, and evaluate all the moving parts that are in that business. And then, of course, you have the enhancing piece, which most businesses are working with. They are trying to increase the value of the business. And we have all these different types of professionals that are out there showing you, or at least coaching you, or helping you increase the sales, increase your revenue, increase your profit margins, all of those things. Everybody tries to help businesses do that, which is excellent. I mean, I think that a lot of those business coaches, and I'm actually one of them, doing an excellent job in increasing the value of a company. So that's E3, and E4, of course, is exiting. And of course, if you are in business and you don't have an exit plan right now, you better get one. It's that simple. All right, let's get to the ratios. Let's get to the profitability ratios. Now, scratch that. Let's go to the key ratios. All right. And again, this is kind of what we do. We kind of take a look at different ratios, and this is part of our evaluation piece. I just threw some numbers up here. Actually, that's not totally true because this is part of a company we did before. And I just made it up to 2022. So let's say hypothetically, this particular company is 219 to 222. We look at 4 years, and let's take a look at what's going on. So their balance sheet, they have cash on hand, which is excellent, and notes receivable, accounts receivable. If you look at it throughout the 2019 to 2022, but these are what we're going to look at from the balance sheet when it comes to the ratios. Income statement, okay, total sales. You can see that they've increased over the years, which is good. Their gross profit, pretty good. Total operating expenses, net income. Now, all right, let me just say this so you understand as a business owner. If you are going to tell Uncle Sam that you're not making as much as you really are, which of course your CPA is going to help with structuring it and telling you what kinds of write-offs you could actually have in your business and so forth and so on. Then you're going to show Uncle Sam that your net income or loss is not as good as what it really is. But I need to tell you something that you probably already know. When it comes to the value of a company, I mean, all of these numbers say something, all of these numbers. But what a buyer of a company, if you're going to exit, what a buyer actually looks at is this net income right down here. And you probably already know why they're actually going to look at that number. They're going to look at that number for a variety of reasons. Number one, if that number is really low or you're not making any money, why in the world would I buy a job? I don't want to buy a job. They want to buy a cash cow, and for several reasons. They want to be able to acquire a business that is consistently making money so they can, A, have a good ROI, return on their investment. B, they may even say, okay, I'll give you 50% down if you carry another 50. And rightfully so, because they have cash there to pay, they pay you back by using that cash that's available. So there's a variety of ways to actually structure a deal based on that little net income. So when you're in business, what I want you to focus in on are these numbers, your balance sheet and income statement. But the bottom line, the net income, you want to increase that as much as possible. Okay. So now let's go a little bit further down. We have profitability ratios. Now, based on the numbers, the balance sheet and income statement, we have the profitability ratios. Return on equity. Notice that this is actually increasing a little bit. Return on assets, return on sales, gross profit margins, asset turnover ratio. Okay. And that's using these numbers up here. Okay. And so current ratio is 1.3, quick and acid test ratio 0.86, leverage rate ratio is 211%, long-term debt 0.335. That's about good. And then the debt to equity ratio is pretty solid as well. So what you're going to do is use an Excel spreadsheet just like this. If you need it, just reach out and I'll send it to you. And it's really easy to look and assess these things, these ratios. Now let's jump to the profitability ratios. All right, so, and again, this is just a different company. I just typed it in, XYZ Corporation today, June 18th. So this particular company sells 3 million, cost of sales 2 million. So the gross profit margin is 32.1%. And see, that's what people look at. Buyers look at this and say, okay, well, let me do some calculations here. You know, you send me your P&Ls, I'm going to take a look at it. That's 32% gross margin, profit margin. What's the industry average? So they might look at the industry average to see what that margin is. Because a lot of times that margin might be better, it might be worse. Operating profit margin. Operating profits 200,000. Again, sales 3 million. And I was actually playing with this number for a client. So it's actually not 200,000. I think this one was 650,000. I can't remember. And so that's a operating profit margin of 21%. And again, these numbers obviously change, not a problem. Net profit margin, net profit after tax, 231. So that's at about 7.5%. And again, I think that this was like 350, something like that. So 11%. The idea is that you want a healthy company. You want to be able to look at this at least quarterly. Return on assets, net profits after taxes. Let's go ahead and make this about 325. And total assets, so we're looking at 9%. You'd like to see that in a double digit. Return on equity, 11.8%. Earnings per share, 2.9, $2.90. And price earnings ratios, 11.1. And in other words, in these ratios, this is not rocket science. It's just one of those things that you want to make sure that you actually know, being a business owner, what you are actually doing. Okay, and that's what's really important. Are these things. Now, let me go back to, I want to go back to this slide again. Our system right here is really, really powerful. I'll tell you, and I'm not saying that because we developed this system, but our system is really the 4 cycles of business ownership. You are in one of these 4 cycles. Either you're entering, evaluating, enhancing, exiting. You're probably in the enhancing stage. And if you want to enhance your business, what you really need to do, and I say this not because I do it, but you need to hire somebody outside of your business to help coach you through your business. Okay, I'll say that again. What you need to do is you need to hire somebody that's outside of your business that will help you through your business. Because a lot of times, small business owners, I'm not talking about corporations. Corporations have infrastructure that's everybody's watching everybody's back and looking at spreadsheets, looking at P&Ls. They're looking at everything to cut costs, to improve margins. They look at ratios daily. But if you're a small business owner, you don't have the time nor the resources to actually do these things by yourself. So that's why you need to hire, and you can hire somebody that is inexpensive that will help you through this process. If you're interested in looking at improving the value of your company, if you really are serious about doing that, then give us a call. Please give me an email. I'll sit down and I'll chat with you to see really where you can go, and if we can actually help you, or if we can refer you to somebody else that can. I have a database that will help people help you all the time. I've got a colleague that will walk into your business and do some work for you for free and show you that he can enhance your business. Anyway, Again, this is Doc C. Thank you for taking the time. This is kind of longer than I expected, but God, I could talk forever. If you want to reach out to us, you look at our website, www.ccochraneconsulting.com, or send me an email, cochraneconsulting@yahoo.com. Thank you again. Look for us again. We'll have another one of these up and running. Take care. Bye-bye.